This presentation is for Chapter 4, Cost Management Systems, Activity-Based, Just-in-Time, and Quality Management Systems. In Learning Objective 5, we are going to describe a just-in-time management system and record its transactions. The cost of buying, storing, and moving inventory can be significant for companies. To reduce inventory costs, many companies use a just-in-time management system. So companies with just-in-time management systems will buy their raw materials and complete the finished goods just in time for delivery to customers. This means that inventory levels are kept low. A customer order triggers the purchase of raw materials and the completion of the product. So production in a just-in-time management system will be completed in self-contained work cells as shown on the slide. So a work cell is just an area where products are manufactured using what is called a continuous flow processing. Everything needed to complete the manufacturing process is readily available. Each work cell will include both the machinery and the labor resources to manufacture a product. The employees work in a team in the work cell, and they are empowered to complete the work without supervision. Workers will complete a small batch of units, and they are responsible for inspecting for quality throughout the process. As the completed product moves out of the work cell, the supplier will deliver more raw materials to the cell just in time to keep the production process moving along. By contrast, traditional production systems, as shown on this slide, will separate manufacturing into various processing departments that focus on a single activity. Work in process must be moved from one department to another as indicated by the red arrows. More movements waste time, and wasted time is wasted money. Just-in-time costing is a costing system that starts with the output completed and then assigns manufacturing costs to the units sold and to inventories. So the differences between just-in-time and traditional costing are: 1. The journal entries for just-in-time are made when the product is complete. 2. There's no work-in-process inventory. 3. There's only 2 inventory accounts, one called raw and in-process inventory, and then finished goods inventory. 4. There's no separate accounts for direct labor cost and manufacturing overhead. Instead, we have a new account that's called conversion cost that is used to accumulate both direct labor and the manufacturing overhead cost. So again, raw and in-process inventory is really a combined account for raw materials inventory and work-in-process inventory. The conversion cost account is a temporary account that's used to accumulate direct labor and manufacturing overhead costs and then allocate the cost as the units are completed. This slide compares traditional and just-in-time costing. In traditional costing, the cost of the products are recorded as they move through the manufacturing process. In just-in-time, the costs are recorded when the units are completed. In traditional costing, we have 3 inventory accounts: raw materials, work in process, and finished goods inventory. In just-in-time, we only have 2 inventory accounts: raw and in-process inventory and finished goods inventory. Under traditional costing, we will have 3 different types of manufacturing costs: direct materials, direct labor, and manufacturing overhead. But in just-in-time, we have direct materials and then conversion costs, which combine direct labor and manufacturing overhead together. On this slide, we're going to look at how to record transactions using just-in-time costing. In transaction 1, we're going to record Smart Touch Learning purchasing $305,000 of raw materials on account. Notice that the debit is to raw and in-process inventory, and the credit is to accounts payable for $305,000. In transaction 2, we are going to record the labor and manufacturing cost. Smart Touch Learning incurred $239,200 for labor and overhead, so we would debit conversion cost and credit various accounts for $239,200. Next, we are going to record the completed production. So if Smart Touch Learning completed 2,000 standard model tablets during the period, we would take the standard cost of $268.80 as we calculated previously using activity-based costing. We would multiply that by 2,000 to get the debit to finished goods inventory of $537,600. Then we would take the $150 for direct materials multiplied by 2,000 tablets to get the $300,000 that we would credit to raw and in-process inventory. For the conversion cost, we would take $118.80, multiply that by 2,000 to get the credit of $237,600 for conversion cost. As the tablets are sold, we would record the sale and the cost of goods sold. So if Smart Touch Learning sold 1,900 tablets on account for $500, we would debit accounts receivable and credit sales revenue for $950,000. To record the cost of goods sold, we would take the standard cost of $268.80 multiplied by 1,900, and we would debit cost of goods sold and credit finished goods inventory for $510,720. This slide shows the T accounts showing the movement of the goods from raw and in-process inventory and conversion costs to finished goods inventory that we recorded in transaction 3. It also shows the movement of the cost from finished goods inventory to cost of goods sold that we recorded in transaction 4. The last entry that we need to record is to adjust the conversion cost for the underallocation of the actual cost. So the actual conversion costs incurred were $239,200, but we only allocated $237,600. So there was $1,600 in the conversion cost that was under allocated. To make that adjustment, we would debit cost of goods sold and credit conversion costs for $1,600. When we look at the T accounts at the bottom, we can see that after we make the adjusting entry, now conversion cost has a zero balance and cost of goods sold shows the actual cost of the goods of $512,320. And that is the conclusion of the presentation for Learning Objective 5.